Andrew, thanks for chatting to us today.
Thanks, Patrick, and thanks for having me.
Well, let's get straight into it. First of all, where should investors be looking for income given the cuts we've seen to dividends on the ASX?
Yeah, I think it's quite clear, isn't it, that companies will need to restore their balance sheets, restore their liquidity buffers, and given the uncertainty of future projected earnings, it's not unreasonable that companies have been more cautious or restricted their dividend payments to investors. Unfortunately, you've also seen material declines in share prices combined with now lower dividend payments to investors flowing through. So I think I think our asset class does provide that alternative for investors. You've got stability of capital through the debt part of the capital structure. You're not exposed to the significant market volatility of the equity asset class. And given companies have entered into contractual arrangements, they're obviously obligated to meet those interest and fee payments to us as a lender. So, I think that's an attractive way. There are other asset classes, but obviously, our asset class is something I'm very familiar with and comfortable speaking to. So certainly in our asset class, the continuity of income flows and distributions to investors is likely to continue.
Do you expect distributions on corporate debt to be affected by COVID-19?
Look, I think the impact to us and our funds has been felt as a result of reductions to the floating base rate. So at the moment, you've got BBSW that's actually now pricing inside the RBA cash rate. And so that has an impact in terms of the total quantum of income. But certainly, there are other aspects associated with it. So some companies looking to retain and preserve cash are deferring the payment of cash interest. So, extending out the date of which interest is due and payable. Under our facilities, a borrower can elect when they pay interest between, say, 30 days to 180 days. And so you are seeing some borrowers wanting to extend the cash payment date as a means to do that. But overall, given our portfolio, for instance, in our funds, are well diversified across, 100 odd individual borrowers, you've got borrowers that are paying cash and interest obligations on an ongoing basis. And certainly a number of the borrowers and industries and companies that we lend to are not all adversely impacted as a result of the virus and the lockdown arrangements. So it's a little bit unique in certain industries and specific to certain companies, but I don't believe it will impact the overall quantum or our ability to pay cash distributions to our investors.
Are corporates a riskier investment these days then?
It's interesting. I think that a lot of people hear things like, global credit or high yield credit and assume that the market is homogenous. Certainly in the Australian market, I think we benefit from, standard lender protections, covenants, security and controls that restrict the risk. Now, it's important for investors to always understand, where do you sit in the capital structure? The asset class investors invest in for growth in capital is the equity asset class. So shareholders are buying equities in companies, expecting growth in earnings to deliver upside capital gains and value. They invest in the debt part of the capital structure to lower that risk of loss. And so from our perspective, what we always look at is the quantum of equity in the capital structure provides the buffer for the risk of any potential loss to us as a lender. And having appropriately structured terms, conditions and covenants and controls are means to mitigate risk. Certainly in parts of the market, the banks are quite clearly on record as indicating the potential risk around increasing bad and doubtful debts. Those bad and doubtful debt increases for the banks are likely to be caused as a result of increased exposure to a broad range of SMEs and also to the consumer sector as a result of potential rising unemployment levels.
So if shares in corporations have gone down, should the prices of corporate loans go down as well due to the increased risk?
No, it doesn't work that way. So effectively what ends up happening is you may have a temporary reduction in the value of a company. So for instance, there are companies that we have negotiated amendments or waivers to their covenants over the last couple of months because their covenants are structured off earnings. And as a result of the impact of the virus and how that's impacted company earnings, those companies have asked us to amend or waive the testing of a covenant. But similarly, some of those companies have then turned around within short order and completed material equity raisings. So whilst the value of the company may have gone lower, the value of equity at risk has actually increased in cases where companies have undertaken equity raisings. And as we've sort of seen, you're seeing a material number of companies come to market and undertake deeply dilutionary equity raisings, effectively destroying value for existing shareholders. But that additional equity is being raised to increase liquidity buffers and restore balance sheets to assist companies to get through this period of time. Every dollar of equity raised or every dividend not paid to a shareholder reduces the risk of loss to us as a lender. So those sorts of things actually mitigate the risk of loss. But you've got to remember too, where we sit in the capital structure means that equity can go to zero in value before we as a lender have lost 1 cent in value. So from a true risk of impairment, equity value has to be zero and the value of the enterprise has to break in the debt value before you have actually crystallized a loss.
There's been a fairly well publicised disconnect between the value of certain private assets, for example, infrastructure and unlisted property, compared to their publicly traded equivalents. Have you observed any similar phenomena in private credit?
I think it's interesting, you know, at the end of it, the equity asset class will always have some degree of subjectivity as to the value. Investors will have different views around forward forecasts of earnings and different views as to the appropriate growth rate and valuation that attaches to those forward earnings. In the debt part of the capital structure, it's a contractual obligation. So a company enters into an arrangement to borrow money from us. They're contractually obligated to pay the interest, pay the fees, and pay the principal on maturity. Failure to do that or a breach of covenant may result in enforcement and insolvency action. And so companies are incentivized through insolvency laws to ensure that they adhere to their contractual obligations. And we've not seen that large disconnect. Obviously, in certain public markets, you've seen a material disconnect. So in offshore markets, you're seeing the ratings agencies indicate that some sub-investment grade and high yield debt in offshore markets are likely to be exposed to increasing levels of risk of loss and default. But in the Australian market context, we're not seeing that. So the actions that the government has taken has been supportive of certain industries that have gone through difficult times. But I guess for us as a lender, it's about the industries and sectors that you tend to avoid that are means to ensure that you're protecting the capital value of your investors' portfolios. And so there are a range of industries that we would say are subject to greater levels of cyclicality or structural decline that were unattractive industries to lend to. And so a number of those industries, unfortunately, have been the ones that have been most impacted as a result of the spread of the virus and how that's impacted businesses. So, you know, we've seen it through the tourism sector. We've seen it through the education, student accommodation, airlines, retail, hospitality, flowing through into retail property trusts and the like in terms of impacts on their business models. But for us as a lender, it's important to think, okay, do we have a continuation of alignment between the interests of debt and equity, and are shareholders and management incentivized to perform and the company perform? Yep, they might be going through a more difficult period at this point in time. And it's important for us as a lender to be constructive in that process and not force insolvency events in times of crisis. So it's important to ensure that the investors or our investors' capital is preserved, but ensuring that equity and shareholders are equally committed to the retention of value.
Have you seen lending slow down a bit? And if so, how much?
Look, I think we certainly completed a number of transactions over the last couple of months. So in our market, it tends to be that the origination, negotiation, structuring and execution of a transaction may take many months. They're not simple processes where you're buying and selling over an exchange. And so for us as a business, we believed it's important to honour the commitments and obligations that we had to borrowers that we had negotiated and indicated commitments of approval. And so those commitments we have closed. So between the period of early February to the end of April, we'd completed in excess of $500 million of transactions. But they were transactions that were in progress through that period of time. Some of those included, funding for an ASX listed company. We completed a number of property related transactions, and we've seen through those commitments. But certainly for us to deploy new capital in the current environment, unless it was an extremely attractive return for the risk, we've taken the view that market conditions were uncertain, and we wanted to see a little bit of the way in which market conditions might play out. Certainly it is throwing up some interesting opportunities for us, but I think also a lot of borrowers are less or reluctant to come to market seeking to raise funding in times where market conditions are more volatile. Obviously, from a lender's perspective, where there's market degrees of uncertainty, the terms and conditions tighten up, market liquidity tightens up and reduces, which means that for a lender, you tend to find that the terms, conditions become more restrictive and become more favourable to you as a lender, and the absence and withdrawal of capital means that pricing tends to go higher. And so as a result of that, we remain open and keen to participate and find new opportunities to lend, but we're also wanting to ensure that our investors' capital is well protected.
What are some of the key ratios and numbers that you look at when you're assessing the ability of a borrower to repay a debt?
Look, I think the standard is always looking at balance sheet protection mechanisms. So issues around controlling the level of leverage that a company may have, or the loan to valuation against a property. But you're also interested in ensuring proper debt serviceability. And so appropriate interest cover and debt service covenants would usually apply. But in the last couple of months, as business conditions have been materially impacted and demand for companies have been materially impacted and revenues have declined, as a lender, your focus is purely on liquidity management. And so that's about understanding the level of cash that companies have on balance sheet, their access to committed but undrawn credit facilities, the way in which management might respond to that in the form of reductions to their cost base, and understanding how many months of cash burn those businesses can sustain. And so liquidity analysis is very important. But as we move beyond this and we start to see businesses start to re-establish, we're also then concerned to understand what is the likely increased level of leverage that the companies may have incurred through this shutdown period, and what is the likely trajectory of earnings growth over time. And so, from our perspective, what we think we'll end up having is a situation where we'll get beyond this, companies will start to go back and recommence operations. The level of debt might be higher as they've depleted their liquidity balances over a period of time. And in certain industries, there'll be a slower return to normality in terms of earnings. And so we're looking at potentially slightly higher levels of leverage and lower earnings growth over a period of time before we start to see further deleveraging of the companies in various sectors.
How's your positioning changed or potentially not changed as a result of the COVID-19 disruptions?
Yeah, it's interesting. We have gone into this period with probably around 35 to 40% of our total portfolio exposed to commercial real estate. Majority of that is in short-term development financing, and obviously we've seen a continuation through this cycle of activity in that sector. So the construction sector was allowed to continue through the shutdown period. And we were obviously concerned that may have in fact slowed activity on different sites. And we've obviously been working with our borrowers to understand how that's performing. It's been interesting for us. A number of our clients have completed projects during this period of time and settled those projects without concern, without seeing any elevated risk of settlement default. And equally, we've also seen across a number of our clients a continuation of sales that have occurred at or above the valuation price that we've extended the financing to them on. So in that regard, we've seen a good performance across our commercial real estate exposures. We didn't have any retail REIT or commercial office REIT exposures. So the majority of our exposures are in development financing, predominantly in Sydney and in Melbourne, a little bit in Perth and a little bit in Brisbane. We're not, and in other parts of our commercial real estate exposure was directed towards industrial and predominantly logistics sector industrial sites. Across our broader part of our portfolio, we're in a very good position. There are a number of sectors there that I mentioned earlier, be it tourism, retail, discretionary retail, airlines, education, retail property and the like that have been materially impacted, where we have no exposure at all. And so from that perspective, I think we're in a good position. But certainly as we go through this period of time, it's been important to work closely with management and companies to understand how they're performing, how they're seeing, and how they're responding to the market conditions, and ensuring that when we can assist them constructively through this period of time, be in a position to assist as businesses start to re-establish their operations and hopefully start to generate good solid earnings in the future.
Have you seen any defaults in the market?
Across our portfolios, we're in a very good position. We don't have any borrowers that are in breach of financial covenants. We don't have borrowers that are in default. We have no bad and doubtful debts. And in fact, our portfolio is entirely up to date in terms of interest and principal payments. So our performance across our funds and the companies that we've lent to has been very strong. Having said that, there are companies that are doing it tough, and they will need and require assistance from lenders to work through that period of time. And from our perspective, we would do that in the ordinary course, just to work with businesses and management and shareholders to ensure the sustainability of those businesses as people would expect. But we've not, apart from the more notable collapse of Virgin. We're not aware of companies in the industries and groups that we've been involved in that have defaulted.
Well, that's actually all we've got time for today. Andrew, thanks so much for sharing your thoughts with us.
Thanks very much, Patrick. Appreciate the time.